Today I will be showing you a 3-step strategy that I have back-tested a lot of times, and with every time I use this strategy, it kept bringing in a lot of profits. And for this you will need no pattern and no indicator. It will be fully based on pure price action. And by the end of this video, you will know this strategy completely, and you will be able to take profitable trades just like this one and make insane amount of money in your trading account. Now my tribe soldiers, let's get down to business. The first step is to understand the market structure, because that will be the foundation and the laying block of the strategy. This part seems very easy, but if you don't know how this works, there will be a problem. If you make a small mistake with it, it will go on to ruin the whole strategy. One of the very first things you learn as a trader is how to identify uptrends and downtrends. It's like the primary level of trading, and almost every trader can simply identify the trend when price is making higher highs and higher lows. It is called an uptrend. And when price is making lower highs and lower lows, we consider it to be in a downtrend. Yeah, that's simple enough. Everybody must have known this and understand how it works. But why is the trading chief stressing over this? Of course, there must be something I need you to understand, tribe soldiers. Something you must have been doing the wrong way. Now, watch this. So going back to our example, let's say we see a chart doing this, making higher highs and higher lows. As we already stated, that is an uptrend, alright. But then, something interesting happens. The chart starts moving downwards, which in the process, price makes this low and breaks right through it. And this is the point where I see a lot of traders making this mistake. Watch carefully, tribe soldiers, as price broke this low. A lot of traders think we are now in a reversal, and that price is now moving in a downtrend. And based on this assumption, they start looking for short trades, because they now think the price is going to move lower. But what if I told you this chart is still in an uptrend, and it's actually very bullish? Yeah, you see, the price made this low, but this low is actually not a low at all, or even a valid one. Why? Because price never broke the valid low, which is right here. Yeah, the only way you can get a valid low is when price breaks the previous high. If price did something like this, where price did not break the previous high, this would not be a valid low. Now, I will make this clear. In order for a low to be validated, it needs to break the previous high. You need to understand this part of the strategy so that the strategy will work for you. For example, if price breaks this high, we will know that this has become a valid low. So now, price is in an uptrend, which means we should only be looking out for bullish trades, and the only time we would start looking for short trades is if price breaks this low. And right here you can see that price can literally do anything. Price can go up, go down, or move sideways. Literally anything. As long as it does not break this low, we are still in an uptrend. Now, look carefully. If price do this, what are we in? Well, a lot of people would say downtrend, because we broke this low right here. But like I said before, a low is only validated if it breaks the previous high. And as you can see, this low did not break the previous high, meaning it's not validated. So we are still looking at our previous low, which price has not been broken yet, meaning that we are still in an uptrend. Now, let's say instead of doing this, the price then end up breaking upwards. Since price has broken our previous high, our new low will be transferred from this point to this one. And yeah, this can be slightly confusing at the beginning. But the main thing you have to remember is that the only way a low is validated is if it breaks the previous high. If you remember that simple rule, you will easily be able to identify if we are in a bullish trend or a bearish one. That is our first step, identifying if we are in an uptrend or a downtrend. So what's next? We move down to step 2. Step 2 is identifying supply and demand in the markets. Demand zones take place in uptrends, and supply zones take place in downtrends. A good way of thinking about this is that you want to buy from demand zones and sell from supply zones. The reason why you want to buy from demand zones is this. Here, if we look closely, the market is going up, and since we saw a large push from the beginning of this move, it simply shows us that a lot of traders wanted to buy from this point onwards, so we can assume that if price comes back down to this area, traders will have the same style of thinking and will want to buy in this same area again. A supply zone is the exact opposite. Since we saw a large downwards move from this point on, it shows us that a lot of traders want to sell at this area, so if price ever retests this zone, we can assume that price will again move downwards from this point. This supply and demand theory is the core of our strategy, but we still have one more step in our three-step strategy. But let's put all that we learnt so far to the test on a real-life chart example. Now, looking at a real chart, we see price moved upwards, came down, and then broke this previous high, which means we have higher highs and higher lows, meaning we are in an uptrend. And since we are in an uptrend, we are only looking for long trades. We do not look for any sell position, since selling in an uptrend is not a good idea. And now, since this low broke the previous high, this is our valid low, and price can only change to a downtrend if it breaks this point, so it's clear that we are still in an uptrend, and on that, we want to only look out for demand zone opportunities. We can find our demand zones by finding an area of consolidation or a point where price moves sideways before having a sharp move upwards. As you can see from this chart, we had some consolidation right here, and after that, the price shot straight upwards. How I like to mark my demand zones is by marking the candle right before the impulse move. So you grab your rectangle tool and find the area of consolidation before the big move, then mark from the low to the high of the previous candle, just before the big move. This is our area of demand, and again, we are not even considering the areas of supply because we are in an uptrend, so we don't need to worry about that. We wait for price to re-enter into this zone, and this is where we would enter, setting our stop loss right below the former low, and set your take profit target at the next high. And here you can see the take profit target got hit successfully, and that's one winning trade. To show you how powerful this strategy can be, we will take a look at a few more examples. Take a look at this example. Here we are in an uptrend because price is making higher highs and higher lows. As you can see, this low is what broke the previous high, so this is where price needs to break in order to be in a downtrend, and that is exactly what happened. So now we are in a downtrend, and we only look for areas of supply in order to take short trades. So we mark our area of supply, and as price comes back up to this area of supply, we enter a short trade and set our stop loss above the last high and set our take profits at the next low. But hey, we are not done with the market yet, because price created another area of supply up here, and we are still in a downtrend. So we wait for price to return back to this new supply zone, and when it does, we enter a short trade and set our stop loss above the area of supply and our take profits target at the next low. Our take profit target got hit successfully, another winning trade. This strategy comes with a lot of benefits. 1. It is extremely accurate, and 2. You are only trading in the direction of the trend, which raises the probability of you winning a trade by 90%. And as the popular trading quote says, the trend is always your friend. Now that we have learnt the first step and the second step of this strategy, the third step is mainly on the risk management plan and the time frame that we will be using with this strategy. First, I will say that you must pay attention to your risk management plan and pick on a good risk management plan, beginning with the ones I have already illustrated in this strategy. If you are trading with an account size of $200, don't go trading with a lot size that will make you risk $100 on a single trade. Instead, reduce your risk with a smaller lot size or leverage that will make you risk about $20 for each trade. This is very important to keep you thriving in the long run and save you from gambling with your money in this professional trading market. Concentrate on a single time frame when trading this strategy, as it is easy and does not need too much analysis to bring in profits for you. Just follow all the rules and steps that I have laid out and backtest them on your demo account before trading them on your real account. Now, you must think that this is the only simple strategy on my channel until you see this trading strategy that has a 90% win rate and can even be used for swing trading. Rush now and learn it and gather more strength, for the journey to the top is yet far. If you want to become my student and learn from me personally, use the link in the description box below. We are the Trading Tribe, and it's a wrap for this video. See you in the next one.